Hey everyone, this is Erica Studdard, and this is my presentation on business structure, comparison, and analysis. So let me start it. Okay, so the first one that we have is a sole proprietorship. In a sole proprietorship, there is only one owner. There aren't very many formalities, but the owner must be aware of and obtain any necessary licenses, sales tax permits, and tax identification numbers before commencing business. Its capitalization is limited to the owner's personal wealth and what he or she can borrow. Since there is only one owner, he or she has full management authority. A sole proprietor is tax according only to what the sole proprietor reports on his or her personal tax return. There is unlimited liability, meaning the owner can be held personally liable if something goes awry. In terms of agency, the owner will hire agents, as many as he or she desires. The sole proprietorship dies when the owner dies, or it can be terminated when he or she is ready to end it. So, for example, Jack opens up a cakery. He is the only owner, and he must be aware and obtain the necessary items to form the proprietorship. The money that is used for the cakery is limited to $100,000 that he has saved up and the $25,000 that he's able to borrow. He has full authority over how his cakery runs, and he hires Sally and Bill to act as agents. Jack only makes $7,500 the first year, so he's only taxed on that $7,500. Jack can and will be held personally liable if the proprietorship begins to flop, and it dies when either Jack dies or when he decides to terminate it. So the next one is a general partnership. So in a general partnership, it has two or more owners. There aren't any formalities required, but a partnership agreement is recommended. Capitalization is based off of personal wealth and what can be borrowed. However, more can be gotten in a partnership, considering that there's more than one person contributing. All partners equally manage the partnership unless otherwise stated in the agreement. Since a partnership is not taxable as a separate entity, so that only a single tax is paid by the partners on income derived from the partnership. There's no personal liability for either of the partners, and the partners act as agents for the partnership and for each other. A general partnership can dissolve upon the death of a partner, or if it's partnership at will, it can dissolve whenever a partner wants to withdraw. So an example of this would be, I'll reuse the cakery. Sally and Bill, they decide to open up a cakery, and they decide that they're going to draft up a partnership agreement. That way there aren't any things to worry about if a dispute arises. They both contribute $100,000, and they both are able to borrow $10,000. They both equally manage the cakery, and they're only taxed on the money that they're able to make, and they each are only able to make $3,000, which isn't very much. They didn't do a very good job. So Sally dies and the general partnership ends. So the next partnership is a limited partnership. A limited partnership has one or more general partner and one or more limited partner. A limited partnership certificate must be executed and filed before the limited partnership's existence begins. Limited partnerships attract passive investors who accept no personal liability for the debts and obligations of limited partnership, because only the general partners have rights to the management. Limited partnerships are the same as general partnerships when it comes to taxing. The limited partnership is not subject to federal income taxation. Only the limited partners have limited personal liability. The general partners act as the agents. Dissolution of the partnership can occur in many different ways, but one of the ways that it can occur is if all the partners consent in writing to do so. So I'll use the cakery again, and Sally and Bill, they are general partners, and they decide that they need someone to add more money to invest into it. So they get Jack, and Jack invests about $200,000 into the company. That way they can buy more products and hopefully market it a little bit better. So Jack has nothing to do with any sort of the management whatsoever, and it's taxed based on what is made, like the general partnership. So the termination of the cakery happens when Sally decides that she no longer wants Jack to be a part of it. So they all just sit down and consent in writing that they're going to end the partnership because Jack doesn't want to continue it either, considering that they're not making any money like he thought they would be. So the next one is a limited liability partnership. And in a limited liability partnership, there must be at least one general partner and one limited partner. The formation of an LLP involves a vote of all partners and is only valid once the statement of qualification is filed. Capitalization comes from the limited partner's investments, like the limited partnership. However, all partners have a say in management and have limited personal liability. The limited liability partnership is not subject to federal taxation, and the limited liability partnership terminates when one of the partners dies or the withdrawal of a partner unless the partnership agreement states otherwise. So this is basically the same as the last example that I just gave, except the only difference here is that all of the partners would have limited personal liability. And in this case, though, that if one of the partners dies or the withdrawal of the general partner, then it will terminate. So a limited liability company must have at least two members in order to form a limited liability company. The company must file an articles of incorporation. Capitalization comes from member contributions, and all members have a right in management. The limited liability company's income is taxed once at the income tax rate of the individual members. Each member has limited personal liability, and if there is no designated manager, then the members act as agents. And a limited liability company will exist indefinitely until the members decide to dissolve it. So with this one, we'll use the cakery again, and we've got Sally and Bill, and they both own it. So in order for them to start to form the cakery, they have to file an articles of organization. They capitalize it by each putting in $300,000, and both of them have a right in management. This only gets taxed once based off what they make, and both of the partners have limited personal liability. So if they go into debt, then they don't have to worry about their personal assets being taken. They have Kyle as a designated manager, and they all decide to dissolve it after 5 years because they just keep going into debt. So the last business association is a corporation. And a corporation is an artificial entity separate from its owners, which are the shareholders. The articles of incorporation must be filed in order to form a corporation. Capital is raised by investors that could be enticed by the potential for dividends and stock appreciation. Shareholders vote for the board of directors, who in turn elect the officers of the corporation to operate the day-to-day business of the corporation. The drawback to corporations is that the income of the corporation is taxed twice. The corporation exists perpetually, meaning that the corporation will not dissolve upon the death or withdrawal of any of its principals. So an example of this would be there are 5 friends, and they all are shareholders, and they have to file an articles of incorporation in order to form the corporation. It capitalizes off of selling shares to other people, and the shareholders vote on a board of directors, who would then vote on officers in order to make sure all the day-to-day things are being ran. And yeah, so that's it for all the corporations, or all of the different business entities that we were supposed to discuss.